Hey TMFG community, Carlo Cantino here with John Iaconetti. And in today's Ask TMFG episode, we'll be discussing where to draw your retirement income from when you don't have a pension. So if you do like our content, please do subscribe to our YouTube channel, provide us with a comment, or give us a like. In today's episode, we'll be discussing where to draw retirement income from if you don't have a pension plan. Now, there are many vehicles out there that you've been utilizing to accumulate wealth for retirement, but there's so many questions about where do I take money from in order to have a tax efficient retirement income source. So John, why don't you get us started and let us know, if you don't have a pension, where's that money coming from?
Absolutely. Well, thank you, Carlo. Like you mentioned, there's going to be a bunch of different vehicles that we can take from. So we'll do our best to try to simplify it for you and figure out, what are the pros and cons to taking from each. Obviously, the income that you draw from your original investments are already going to be on top of what you can get in terms of government benefits. So if you haven't checked it out, check out our last video on the government benefits, specifically CPP and old age security that you will be receiving in retirement. Now, in regards to the accounts that you can draw income from in addition to the government benefits, we can break it down between what's considered taxable as income, what's considered tax-free, and then what's a bit more tax-favorable. And what's considered taxable income is going to be primarily your RRSPs, your retirement savings plan, as well as a locked-in retirement account, which may have been from a past work pension, which now you hold in your name in an investment account. So both of those are considered taxable as income because throughout the years while you were working, you were putting money into those accounts and getting tax deductions. Now, when you withdraw it, you're going to be having to pay tax on the money as you withdraw. It's considered a tax deferral program, so it's not tax-free like a TFSA, but it's kicking the can down the road, and now it's come due to take that money out and therefore pay your taxes. The other type of investment where it's entirely tax-free is the TFSA, the tax-free savings account. Just like the name implies, you're able to withdraw and not have to pay any sort of capital gains, interest, or any sort of income on that amount of money that you do withdraw. And then finally, we have the open account or non-registered account, which is a bit more tax favorable because you don't have to pay tax really on capital gains on any sort of disposition within the account. Interest, dividends as well are taxable, but the main source of taxation likely going to be the capital gains on anything that you take from that account.
Thanks, John. Now that we've discussed the types of accounts you can be drawing from, we should really focus on the order of where all of the income comes from. So where you should be starting is determining, well, how much income do I need? What are my expenses? How much of that is going to be covered from the CPP and old age security that John just had mentioned you'd be receiving anyways? Once you've determined that amount, how much more do you need in order to satisfy your monthly expenses? Let's say that number is $50,000. Where does that put you on the marginal tax brackets?
Yep.
Because the marginal tax bracket is important to determine because that's the rate of tax you would be paying on each additional income earned within that tax bracket or within that income range. Let's look at an example of an Ontario resident receiving about $24,000 a year from both CPP and OAS, and they have expenses of about $90,000 a year after tax. So in general, they need another $65,000 of income from one of their accounts. At $25,000, the marginal tax bracket is 20%. And the top of that marginal tax bracket is $51,000 in 2024. That means the additional $26,000 that's taken from a taxable account is only taxed at 20%. Once your income is above that $51,000, you're taxed at a higher rate. That range is $51,000 to $55,000, and that's 24%. The next bracket over that is the $55,000 to $90,000. Any income that's drawn from an RRSP will be taxed at 29%. Call it 30. So in this example, if the Ontario resident needs another $65,000 of income, and you don't want to pay more than 24% tax on your income, then you want to take enough out of the RSP to bring your income from $25,000 to $55,000. So $30,000 would come out of the RSP, and you'd still need another $40,000 from a non-taxable source, whether it's your TFSA or a non-registered account where you may pay some taxable capital gains, but it'll be far less punitive than pulling more out of the RRSP.
Yeah, those are great points there, Carlo. We need to be cognizant of the marginal tax brackets, especially in Canada, because we know we want to pay as little as tax as possible and have as much money in your pocket at the end of the day. One tax that's not quite officially a tax, but very much like one, is something called the old age security clawback, which we touched on in a past video, and that's if your income goes upwards of $90,000, they're actually going to begin to take away your old age security clawback. So that's why it's important that we try to stay below that $91,000 threshold to ensure that we're not clawing back any of our old age security and you're getting what you're entitled to in regards to old age security.
Another great point to mention, John, tax planning is very important when it comes to drawing retirement incomes out of different investment vehicles. If you're unsure of where that money should be coming from, speak with your financial advisor today for that tax advice. Again, that's another episode of Ask TMFG. If you do like our content, please do subscribe to our YouTube channel. Provide us with some comments. Let us know. Are you drawing from your TFSAs first, non-registered accounts first, or RSP? Let us know in the comments why you're doing what you're doing. Or just give us a like. Until next time, I'm Carlo Cancino.
I'm John Yocconetti.
And this has been Ask TMFG.